Hi, my name is Matt Walsh. I'm the founder and CEO of Splish Naturals. I recently attended Carl Dakin's Motivated Money Bootcamp. As my company begins to launch its crowdfunding campaign for upwards of $3.5 million, I can't say enough about the class, what I learned, and how much I recommend it to any business looking to raise capital.
Have you ever wondered what it takes to successfully raise money? I have worked with hundreds of capital campaigns across dozens of industries, and I'm here to share with you proven methods for raising money in record time and at the lowest cost, while also obtaining capital at the lowest price. My name is Carl Dakin, and welcome to Motivated Money. Hello, this is Carl Dakin, and this is the Motivated Money Podcast. This is a show where I talk about motivated money. I talk about helping entrepreneurs raise capital, and we focus on trying to do this quicker, better, faster so that you can get through your capital campaign and get back to business, doing whatever it is that caused you to get up in the morning. And with that, in the motivated money approach, what we try to do is identify people who are most likely to invest, who have the greatest motivation or incentive to invest, because they stand to get secondary benefits or value beyond the investment. And this makes them the prime target, the center of the bullseye that we want to focus on when we put together our capital campaign, when we draft our offering, and we put together a promotional document. So we know who to talk to, why we're talking to them. And there's a chance, as our ultimate goal, they will love us more than we love ourselves. So with that today, I have with me Whitney, who is involved in investing into a variety of vertical markets. So she is an investor, and you need to listen carefully to what she says, because if you're looking for capital and she's telling you what she needs to see or want or what she's working with, and you match up, then it's a match. And if you don't, then you need to go talk to somebody else. And it's nothing against Whitney, but it's just she doesn't invest in everything. They don't cover the entire spectrum from A to Z or from top to bottom. And we're all about being efficient, effective in raising capital. So Whitney, tell us a little bit about yourself and your company and what you do.
Yeah, definitely. Well, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com, and we are a private equity firm that focuses on multifamily self-storage express car washes and hotels. We also have a first position lien real estate debt fund. And really, we are striving to help our investors invest across multiple verticals for cash flow, equity gains, tax benefits, and diversification. But really, at the end of the day, they get that passive income so they can go out and create the impact that they were meant to make in the world. I started off real estate investing personally in 2002, completely by accident. I feel like I've done nearly everything under the sun, from flipping to house hacking to, buying my own multifamily buildings. And then, really realized that I needed to supercharge the scale of my portfolio and, stepped into institutional quality assets in JV partnerships, but also as a limited partner. So I can talk to both sides of the table here as far as, some tips and hacks to raise capital funds, but also as myself as a limited partner investor, what I'm looking to hear. But ultimately, the end of the day, I come from a public health background, and I firmly believe the lack of financial education, the lack of empowerment that people have for taking control of their funds and learning how to invest them themselves is a public health issue. Because if we could eliminate that issue where people felt empowered and control and skilled enough to take charge of their own money, and not only create it, keep it, but grow it and then pass it on to the next generation, we could probably eliminate a lot of the pain that we see in the world.
Yeah, and I so totally agree with that. In my work with workforce housing, it is one of my primary goals for the tenant of the house, the household unit, to be building wealth in that unit and not simply be an apartment dweller who is constantly flowing money out. And actually, even at the community level, I'm still having arguments with different communities about a lot of the housing programs that extract money over time from the community and actually cause the community to lose wealth as a consequence of how the whole thing is structured. So I'm a fan already of what you're saying. And so if an entrepreneur were to come to you with a project, what would you want to see from that entrepreneur? How would you coax, teach, train them to give you a package that's perfect, dead center of the bullseye for you?
Well, for me as a passive investor, well, for one, the package has to align with the goals that I have for my investing portfolio. So really, I think it goes back to that relationship conversation, building that conversation. And so just because you have something that's, landed on your landing page, or you exchange, contact information, say at a meetup or a conference, it doesn't mean that person, they're just a lead. They're not actually a prospect yet. And so essentially you have to qualify them, understand what their goals are, what their risk tolerance is, what their investment timeline. And then you get a sense of, oh, are they a good match for my company? Or am I a good match for them? Because that's even a really unique opportunity, even though if you're like, man, this person will never invest in my project, we're not aligned. One, you get to identify, you can conserve energy, but not pushing a rock uphill. But two, you still get to serve, because there's probably somebody in your network that you can connect them to. Now, why would taking that extra step, that extra effort to connect somebody in your network to another person's project and not keep them for your own and try to convince them to invest in your own project? It can reap rewards and pay dividends, because now you're now known as a super connector. And that person, even though your project didn't match, they then, might know somebody else that your project's great for their portfolio. Or, maybe they've scaled, we see this pretty often, somebody who has scaled in, maybe they wanted to do development deals, and then they transition to another part of building out maybe more stabilized cash flow in their portfolio. They come back to us because we help solve a problem for them. So that would be kind of the first big step. One, understanding the goals, matching the goals, the risk, the timeline. And there, it's speaking to solving their problem that they need to solve with their portfolio, not so much like, hey, here's my project, here are all the nice shiny numbers, you want to invest, right? Really kind of, deep diving into that relationship and, helping them understand how the project will solve their problem and help them create a better life for themselves. I can go on further, but I'm going to put it down for a second.
That's fine. I'm going to take a couple side notes again. So when you do an introduction of someone who does not match with you by trying to get them to where they need to go, I call this a social investment. This is a social asset that you're building in your relationship. And it's one of the things when I talk with entrepreneurs about raising capital, I said, how many people are on your team? And all too often it's 1, 2, 3, 4, or 5. And I say, well, if you had a board of 10 and you had a board of advisors of 20 people, and each of them know 200 people, now we're talking 5,000 people that are within your reach. You have access to them. And a lot of people don't think about the fact that the quickest way to get to the right match is to have a lot of people out there acting as scouts for you in the public through relationships, which is the number one requirement. I always tell everybody, if you don't know the person you're talking to, the likelihood of an investment goes way down, if not totally to zero. So I totally appreciate your approach to making sure that if someone comes to you and they're looking to make an investment and it doesn't match up from their standpoint with what you're doing, you're still investing into that person, into that relationship, and moving them towards something that may match up better.
And it doesn't have to be a huge energy expense. I mean, you can actually automate that type of process pretty readily. You could start off with a email template, that lives in your email, and just be like, hey, here's some quick resources, right? Maybe you have 2 or 3 different objection profiles, somebody who's not a sophisticated investor and you're only looking for accredited investors, or maybe somebody who's looking for development deals and you only do cash flow deals, right? So you can set up those profiles, those templates really simply. You can also automate this through your CRM, which I love, because then you can tag why that person isn't a match. And then maybe identify like in a year or two, hey, maybe I should create an offering that would match this type of investor. Fantastic. You have already, one, talked to them, two, helped them solve their problem, three, you've categorized them. And now you can go back to them and be like, hey, we spoke a year ago. You really wanted to do X, Y, and Z. Guess what? We now have this fund open that would help you achieve this goal. Would you like to circle back and jump on a call? Right. So, you can continue to feed that and develop that relationship and really speak to them.
Yeah. So, and this is something, again, for entrepreneurs on the other side of the fence, is that if you go to an investor and you don't meet their criteria, but you learn and take the time to understand what they invest in and how they invest, it may be that you're simply too early, and you can go back to them 6 months, a year, 2 years down the road when you've accomplished more and your business has matured more. And now you may meet those criteria, but because you've already established a relationship with that investor candidate, you don't have to start from scratch. It's not a cold call when you get to your second, third, or fourth round of funding. But before we go on, you mentioned you use a CRM, and I'm going to be looking for sponsors for this podcast. So tell me what CRM you're using, and maybe I could convert this into a testimonial. And
I don't know, maybe. We currently use ActiveCampaign, but we are finding that ActiveCampaign, is fantastic for starting off with, and it's great for marketing, but we need additional layer of support. So we're bringing on HubSpot.
Okay. And this has been my experience. For doing capital campaigns, and particularly if you're doing crowdfunding, where you're getting large number of people making a large number of small dollar investments, you have to have a CRM. You can't do it by hand. It's not a manual exercise. I'm using Zoho. And it's got all kinds of capabilities, and I'm not going all the way up the ladder to the top end CRMs because I don't have the time to learn and use those. But a lot of times we see somebody start off with something simple, and then they progress, as I say, or mature, however word you want to use that, to something that has more feature sets that's more appropriate to them. But you need to have something to start, and I will see if we can get your CRM to say, hey, yes, I'll be a sponsor of Carl's show. Anyway, back to business. So in this framework of, you mentioned that you do these different verticals, and as I'm hearing what you're saying, you're looking for something that is already built, so you're not putting money into development or anything along that line, and you want something that's kind of already sold out, where the customers are in place and it's cash flowing, and this creates a relatively stable, consistent type of revenue for your investors. Is that a good description?
In general, yes. And we look for more like a value add type strategy. So, and it doesn't have to be deep. We don't necessarily like the deep value add with, tons of CapEx and deferred maintenance, but looking for other ways of capturing equity, capturing NOI growth that was maybe left on the table. So, for example, when we purchase our Class A multifamilies, we often pick them up from developers. A developer, they're not in it to tenant up the property. If they can exit the property at 50, 60%, they're happy. Heck, if they could exit it at 0% occupied, they're happy. So, but most people can't get a loan at 0% occupancy, but around 60%, 70%, you can start getting different types of lending. So we look for those type of value adds. With our self-storage properties, we are looking to be in major metropolitan service areas that, more kind of class B plus, A class areas still, but that also have expansion components to them as well. So maybe some extra land where we can build an additional 20 or 30 or 40 units. We have a neat RV storage project in Indianapolis where we're doing just that. And then, with our car washes, though, that is a business strategy that owns real estate. So we're looking to grow a portfolio of 250 to 300 locations, condensing this fractionalized industry from mom and pop ownership. And, all of these, we're looking for stabilized car washes, but also ones that are, again, underutilized from an NOI perspective, or a low EBITDA growth perspective. So we can layer on our marketing, various technologies in order to boost the NOI growth. Now, with our car washes, we will also do development to scale in 3 years to 250 to 300 locations. We need to tackle both acquisitions and as well as development. But we mainly do stabilized acquisitions.
Okay, and I totally get it that you want something that's cash flowing, but it's not reaching its full potential. And by you doing what you do to value add, you are both increasing the profit margins and you're also expanding the revenue potential, which gives that investor just that much more upside when they invest through and with you. So when you have investors coming to you, what kind of rate of return are they looking for their investment that you try to achieve with your programs?
Well, so, this has been a really interesting time in the past 12 months to raise capital, because I'm sure many of the listeners here are feeling the same pain. They're trying to acquire an asset, and the seller has not thought, or hasn't occurred to them, that their asset is not worth as much as it was, with cap rates rising as well as interest rates rising. Where on the other side, the investor is still sitting here going, I want to chase yield. I still want to get this return, the 7 or 8 pref that I was getting just 2 or 3 years ago. So it's been a really interesting time. We still target assets. We still have a very strict buy box. We are targeting assets where we can, get a minimum of 3 to 4% cash flow year one while we're stabilizing, and then grow that potential, especially in the multifamily and self-storage, grow that potential to 7, 8, 9, 10% by year 4 or 5. Now, on the car washes, we are looking to stabilize year one cash flow somewhere between 3 to 7%, depending when in the year we buy it. If we buy it in winter, cash flows are going to be a little bit lower for year one. If we buy it in the summer, they're going to be a little bit higher, right? Because that's the car wash season. But with car washes, we can help investors achieve that yield, that stabilized yield, by hitting probably somewhere like around 10 to 12% by year 3, and then growing from there. Now, our return profiles are for our multifamily, self-storage, and even our hotels are going to be a 7 or an 8 pref, 7 on the multifamily in self-storage, 8 pref on the hotels, and then a 70-30 split to 13% IRR, and then 50-50 after. And then on the car washes, we offer a 10% preferred return, 60-40 split to 20% IRR. And then when we go past 20% IRR, we flip it to 40-60. And then when we get past the 30% IRR, we leave our investor uncapped, which is highly unusual, at 10-90. So they still are participating alongside that deal with us. And on the car washes, we're actually looking to IPO that, which will give an additional equity bump on the back end.
Whitney just gave us about 40 new investment terms that some of you may not have heard about before. And I'm following the conversation just fine, but I'm starting to feel concerned for some of our listeners. We do have an aid that's outside of this program. We have an AI system called the Entrepreneur Coach that you can ask it for definitions of any term that's out there, and it'll give you a definition back. You can get to that by going to entrepreneurcoach.pro. That's a URL site, entrepreneurcoach.pro, and just say, what is a cap? What is this, that, or the other, as Whitney was describing, and it will give you the answer, and you can ask it as many questions as you want, and it's all free. But I'll just throw a little plug in there for one of my other projects, because I laugh because I say I know more types of money than Eskimos know types of snow, and people go, what does that mean? I go, well, you got time and rate and risk and location and all these other things, and they're all different. And even two companies that start 6 weeks apart that sell the same product, maybe in a different market at a different time and a different level of maturity, and therefore are looking for different types of money. Even just 6 weeks can make that much difference. So are most of your investors, are they individuals, or are you doing strategic stuff with people who might be, say, vendors of the building materials for your storage units, or the developers you mentioned in your multifamily?
Yeah, so we're really unrestricted on who we work with, because we fall under, here's another term, 506c regulations. So
Let's talk about that one.
Yeah, okay, good. So we really, we can work with institutional investors, we can work with, retail investors. Myself personally, I largely work with retail investors, because what you just said, I love stripping complexity out of the terminologies, the mechanics, how the things work, and really trying to bring it down to simplified terms. And so I have a resource too, the Passive Investing Made Simple show. It's a YouTube show. It's free. You can go on there and learn all these different terms. And also I show people how, with real world examples, real deals, how things work, where their eyes should be looking in an offering memorandum, in a PPM, to really understand what a passive, all these terms in a passive investment are. But yeah, we work with both types of investors. And also we can work with 1031 exchange money for our hotels and self-storage deals. So, if you have, say $500,000 or more in a 1031 exchange, that is something that we can really help investors place those funds into a high quality institutional grade asset.
So we start off with return on investment to begin with, and then we can amplify that with some tax benefits through a 1031 exchange, or maybe an opportunity zone investment, or some other types of things. And so as the investors are coming to the table and talking to entrepreneurs about making their money available, we're back to matching up. Is your deal going to qualify for a tax credit? Is it going to be in a location? Is it going to be cash flowing? Does it have the ability to make money beyond the initial cash flow by what Whitney's company is doing, by enhancing its operations and expanding its operations? So these all represent what becomes then the wide cafeteria of types of investment opportunities. And as an entrepreneur, you need to be thinking in terms of, do I match up with this type of investor? Is my deal going to give that investor what they're looking for? There will be no Baptist tent evangelism going on here, where you're going, I know you've been investing all your life this one way, and I want you to convert into a new form of investment. That doesn't work. So let's just skip over that and just focus on what the investors are looking for. So Whitney, before we go today, why don't you, you say you do 2 podcasts, if I recall correctly, how would they get to those podcasts?
Yeah, so you can find, you can be on podcast or on YouTube. So the Passive Investing Made Simple show. And you can find that at our YouTube channel, passiveinvesting.com, and dot spelled out DOT. And then also the Multifamily Investor Nation podcast. And we do a webinar for active investors, but we do the podcast for passive and active investors to learn just how these deals get put together, what all it takes, some of the hits the general partnership actually takes, right? Because the limited partner sees a nice shiny offering memorandum, and they're thinking everything's going smooth behind the scenes, right? Because that's what the general partnership is paid to be doing, is to take on all that stress and headache and do that on behalf of the limited partner investor. But sometimes I've got some interesting stories. Sometimes things don't go nearly as smooth.
I'm sure you do have interesting stories. This is a very interesting field. So, and as I'm hearing, what I'm hearing is that you have money to invest right now.
Yeah.
Now, and this is important because we are in the capital industry. We're in a recession. We're kind of the loss leaders for the rest of the economy. But we've seen a retreat of wealthy individuals, private equity funds, going back to first of last year. And depends upon which market niche you're in, you may see cutbacks in investment dollars of 20, 40, 60%. And so if you are looking for money today as an entrepreneur, and as we have both talked about today, if you match up, then this is a source of funding that's still available to you. If you have a project that you need to cash out of, you've got it to a certain level of occupancy or tenancy, then Whitney's group is here to talk to you about if this is a good match. And the good news is that Whitney is offered to socially invest in your relationship. And if it isn't a match, she's going to try to point you to a direction where maybe you can get the kind of capital that you're looking for. So that's it for today for the Motivated Money podcast. Whitney, thank you very much for being on the show. And we'll see you all at the next episode.
Awesome. Thank you so much for having me on, Carl.
Thank you for listening in to Motivated Money. If you like this or any other episodes, make sure to leave a rating and review of the show. We love to hear your feedback and want to make this the best possible show for you. Also, if you like this episode, make sure you share it with someone you know who is seeking to raise capital. They will appreciate learning what you now know about raising funding. I'll see you on the next episode of Motivated Money.